Today is Tuesday, October 7th, 2025, and this is Sliced. Carbon markets need their trace moment. In 2002, the bond market underwent a quiet revolution. The Financial Industry Regulatory Authority, or FINRA, introduced TRACE, a simple but powerful system that made transaction prices public. Trading costs dropped by 50%, and the market ballooned to over 128 trillion USD. That's the power of price transparency. Carbon markets are overdue for their trace moment. Today's voluntary carbon markets, or VCMs, are full of potential but are stuck in limbo. Billions in institutional capital sit on the sidelines, deterred by opaque pricing, fragmented standards, and weak benefit sharing. Without reform, carbon credits will remain a boutique offset tool, not a credible climate finance asset class. To evolve, VCMs must do what bond, commodity, and infrastructure markets have done before: embrace transparency and standardization. That starts with publishing prices and proving impact. Carbon credits are notoriously hard to price. Most transactions happen over the counter with little disclosure. Buyers chase different attributes: removal versus avoidance, vintage, co-benefits, etc., while project methodologies vary widely. The result? No single reference price, no liquidity, and no reliable way for investors to assess risk. This isn't how functioning markets operate. In traditional finance, clear price signals drive efficient capital allocation. In VCMs, the lack of price discovery increases risk and suppresses scale. So what needs to change? 3 things. Standardized contracts that specify credit quality, vintage, and delivery terms. Trusted benchmarks, such as the core carbon principles, informed by institutions like the ICVCM and VCMI, and help buyers assess fair value. Mandatory transaction disclosure in public registries, including prices and project characteristics. Transparency doesn't stifle flexibility, it enables trust. Progress is already underway. A global coalition of market experts have been working through multi-stakeholder initiatives to harmonize credit data and streamline transaction reporting. These technical efforts, including the development of a common carbon credit model and digital market infrastructure standards, are quietly laying the groundwork for scalable price transparency. But for these reforms to succeed, broad adoption and regulatory backing are essential. Each carbon credit today is a bespoke product, tied to a specific project, methodology, and risk profile. That makes trading slow, expensive, and illiquid. Institutional capital, pension funds, development banks, ESG, impact, and sustainable investing funds won't enter a market without standardized products and tools to hedge institutional risk. To unlock liquidity, the market needs tiered credit classifications, similar to bond ratings, grouping credits by risk and impact, carbon-backed financial instruments, for example, ETFs or futures, that improve tradability, standard risk assessment tools so investors can compare like for like. Until credits are fungible and reliably priced, carbon cannot become a mainstream financial asset. Carbon markets aren't only about emissions, they're about people too. For credits to maintain integrity and attract impact and sustainably driven investors, they must demonstrate measurable local benefits, such as improved livelihoods, biodiversity, access to clean water, and more. Yet today, benefit sharing mechanisms are murky, inconsistent, and rarely priced in. Many buyers can't tell how much revenue actually reaches frontline communities. This creates reputational risk and undermines confidence. A single, simple fix: require issuers to report a benefit per ton metric, standardized and verified by third parties, showing how proceeds are distributed and what impact is delivered. Think of it as the ESG label for carbon. Just as ESG scores influence bond markets, benefit per ton metrics could become a trusted signal for investors navigating the carbon space. Many brokers and platforms charge high markups without clear accountability. A 2023 journalistic investigation found that fewer than 10% of intermediaries disclose their fees or commissions. Here's what that means in practice. A buyer may pay $20 per ton, thinking the majority supports reforestation. In reality, only $5 might reach the project developer, and just $2 ends up in the hands of local communities. This erodes trust and invites greenwashing accusations. A simple proposal: require intermediaries to publish fee structures and profit margins as a condition for listing credits on registries or exchanges. Transparency here isn't punitive, it's market making. So what comes next? We've seen this movie before. Infrastructure and bond markets scaled only when they standardized pricing and reporting. Real estate sustainability benchmarks like the GRESB enabled impact comparisons across assets, attracting $850 billion USD in capital by 2022. Transparency doesn't just de-risk, it drives growth. Carbon markets are standing at a similar inflection point. There is $27 trillion USD in pension and real asset funds actively seeking investments with verified climate and community impact. But capital won't flow into a market where the rules are unclear, prices are hidden, and impacts can't be proven. So conclusion, publish the price, prove the impact. Carbon credits could power climate action at scale. To do that, they must earn investor trust by embedding transparency at every level, from pricing to revenue flows. It's time for carbon markets to publish the price, prove the impact, and unlock the capital waiting on the sidelines. Let's give carbon its trace moment.